Hello, welcome back to another episode of Young Money. The YouTube channel aims to cut through all of the corporate bullshit, really, when it comes to managing your money as a young person. By special request, today's episode is all about savings and investing those savings into either the stock market or funds or trackers. In a low interest rate environment, making your money work harder is something that I'm regularly asked about. Is how do you avoid only getting 1.25% on savings that you've worked really hard to be able to accrue? So really, that's what I'm here to talk about today. This isn't a comprehensive video. There's a huge amount of information on this very complicated topic. So there's a lot that we'll need to get through in this video, and even then that's only scratching the surface. This really only aims to give you the kind of highlights and a starter for 10, if you will. Big up my University Challenge crew.
Bunkman, 0.
Because you're investing in things that are quite fluid and dynamic, there's a lot of different circumstances that might have an impact on the value of an organisation or a market. You can see volatility, mean that the value and the cost go up and down quite regularly. You need to be thinking at least 5 to 5 years minimum term. People don't describe this as betting, but that's exactly what it is. Betting is bad and heavily regulated, but a multi-billion, trillion dollar pound industry such as investing in stocks and shares isn't something that people would ever want to describe as betting because of the negative connotation that goes with it. But it is betting. You're effectively placing your money on the future successes of a thing. It's not horses, it's not all on black or all on red, but it is nonetheless putting your money on something of which its future is pretty uncertain. So over this 5-year period, and it should be longer than that because then you're going to even everything out a little bit more, you're going to have to treat your money as being untouchable. So I put my money away in a stocks and shares ISA, and I know that until 2020, I can't touch it. And I have to be comfortable with that, and I have to be able to manage my money aside from that. Some instant access savings, you know that you might want to treat yourself to something a bit later on and withdraw it from there, but there's a little bit more of a complicated system to get your money out of a stocks and shares ISA, which means you really should just be looking at it as a nest egg, a pot of money that you want to use for something later on in life. So question number 1, how do I invest my money? The easiest and cheapest way to invest your money is through an online website. This is commonly referred to as a platform, and there are a few different bank-type organisations that actually offer these. So a few of those are Hargreaves Lansdown, AJ Bell, Vanguard, Nutmeg, and Moneybox. All of these are very slightly and subtly different, so you get different things for your money. Moneybox is this really interesting thing where it rounds up your individual transactions on your bank account to the nearest pound and puts the difference in a stocks and shares ISA that's invested in a fund of varying risk. Hargreaves Lansdown gives you a huge amount of choice in what you invest in, but then again, the annual platform fee is quite expensive compared to some other ones. Vanguard is seen as a really cheap solution, but at the same time, you're quite limited on the choice of funds and stocks and shares that you can invest in. So there are swings and roundabouts to all of them, and you really need to go ahead and have a look into each one to see which one is best for you, depending on the amount of money you're looking to invest. Question number 2. What am I investing money in? When a company decides to list on a stock market, what they're effectively saying is that I'm taking my company as this imaginary thing, and I'm breaking it up into different bits of this imaginary thing, and then I'm going to sell those bits of this imaginary thing to whoever wants to buy them effectively. So when you're investing in stocks and shares, you're buying bits of that company. On some platforms, you have the option of buying those stocks and shares, those bits, directly. There are generally trading fees associated with this. This means that when you want to make a trade, when you want to buy one of those bits, they'll charge you not a percentage, but a flat rate. For example, when the referendum result came through in the middle of last year, I decided that it was a really good time to buy some shares in Lloyds. I bought £50 worth of shares. It cost me £11, and as a result, I'll probably be waiting for about a century to get all my money back on that.
Oh, okay.
An alternative is looking at funds. The analogy I use for funds is that imagine you've got a shopping basket, and in that shopping basket go bits from different companies. And the person who looks after that shopping basket is a fund manager, and they choose which bits of company should be bought and sold and put into or taken out of that shopping basket. What that fund eventually does is you can say, I'm going to break this fund up into lots of imaginary bits and sell a bit of the fund. So you are investing your money in a variety of different companies, but you're only buying one thing. I really like this because it means you get some automatic diversification. And what we mean by that is that you're not invested in one company and one company alone. Because there's a manager for that shopping basket though, that manager can charge you a fee for his managing or hers managing your shopping basket. They can charge pretty much whatever they want, but it will generally be a percentage of whatever you've got in there on a monthly basis. Some of them will charge up to 1%, maybe even more than 1%, but everything lower than 1% is what you should be looking at really when it comes to investing in funds. Lots of studies have shown that fund managers very rarely outperform the market. So imagine the market like the FTSE 100 or the FTSE in general. The progression might look like that in terms of the graph, and fund managers will look a little bit like that all the way along it, but generally the average will still be the same. There are some fund managers though where you'll see their performance does this, and it goes a lot higher, a lot over a longer period of time, and that means that they're outperforming the market and that they're really good. And if you want to avoid the fees that these fund managers charge, you can choose index trackers. Because it's not managed actively, you're charged less for using it. And they invest in the top companies in that market, and they don't spend a lot of time working out which ones are best. Question number 3, how much money will I make? This is a really tricky one to answer because you can't really predict the stock market. I mean, nobody predicted pre-2008 that people would lose a lot of money on the stock market because of the financial crisis. For an indication, the FTSE 100, which is a collection of the largest 100 companies in the UK that are currently listed on the stock market, that has returned a year around 9.4% over the last 5 years. Question number 4, what sort of account do I need? You need a stocks and shares ISA. Personally, I have one with Hargreaves Lansdown. Just to be clear, this is not an advert for Hargreaves Lansdown. There are lots of other suppliers out there. There are a lot of cheaper alternatives to Hargreaves Lansdown that will only charge you a small platform fee compared to the 0.45%, but because I'm not investing a huge amount of money, that's kind of less important for me. So a stocks and shares ISA will allow you to save £20,000 a year tax-free. Bearing in mind £20,000 a year is £1,666.67 a month, and if you're able to save that, then props to you. I know I can't, so the limit really is actually meaningless now, because you're never likely to be able to save the full £20,000 in a tax year. Making sure that you're protected against any great returns that you get from any of your investments is really important. So those are the top 4 questions that I've been asked relating to investing. If you're investing monthly, then your savings will even out the bumps. For example, if you're investing in a particular fund and the price of that fund tends to drop, yes, you'll see the value of the amount of money you have in your account go down. What it means is that the next month that you invest, it will be cheaper to buy the same amount that you had last time. So you get more for your money, and then eventually when that starts to recover, which is likely but not guaranteed, you'll see that your money is even working harder for you, which I think is a real benefit of investing in the stocks and shares ISA. So, let me know if this was useful in the comments below. I recognise it's a bit longer than the average video. I've got to try and trim this down somehow, I don't know. Let me know what you think of the new background. I think that I look like a massive reading nerd. Most of these I haven't read, but also notice the colour coordination of the different shells. I really like it. I've now got Instagram and Twitter, so go follow me, young_money UK on Twitter and Instagram. I'll be posting some stuff on there. You can ask me any questions on there that you might have as well, or you can ask them in the comments down below. So thanks for subscribing. Please do smash that like button as well to help me out a little bit, and I'll see you next time for Young Money!